Swayam Prabha. Digital India. Educated India.
Hello everyone, welcome to this new topic, Advanced Real Estate Risk Analysis and Reits Overview. This will be part of the course Real Estate Finance and Investment Strategy. So first, brief about what we will be discussing today. So basically today we will be covering two parts. One, we started very briefly in last class where we were discussing about risk analysis regarding real estate. So there we will try to go deep into the advanced concepts. So that is one part. And the second one is a brief overview of REIT. So that we will be covering in this particular session. So starting with what is sensitivity analysis. So sensitivity analysis is your basically the first line of defense against investment surprises. Think of it as asking what if questions systematically. The core question that drives everything basically. So if rent drops 10%, how does my IRR changes? Here's why this basically matters enormously in real estate. Unlike stocks that you can sell in seconds, real estate investment spans for 5 to 10 years. Your initial assumption about rent growth, vacancy rates and exit values will almost certainly prove incorrect. The question isn't whether your assumption will be wrong. It's how wrong they can be before your investment becomes unprofitable. So sensitivity analysis identifies which variables deserves your attention, and you will see that not all assumptions are created equal. Some variables, when they change, can make or break your deal. Others barely move the needle. Your job as a professional basically is to focus your energy on what matters most. So there will be some amount of errors, but the idea is that how much wrong you are and where you are wrong actually. So that is how the focus will be, that we will try to see and analyze our different assumptions. So what are the key variables to test? Because we just said that there are different variables, but what we want to look at and how much rigorously those assumptions should stay. So basically, that is, we will basically understand that what are the key variables we have to test here. So we have revenue variables, right, which are your income drivers. So you have market rents and their escalation rates often have the biggest impact on returns. Then we have occupancy rates. They can make difference between success and failure. Then we have lease terms and renewable probability, which affects your cash flow predictability. Then we have cost variables, which includes upfront and ongoing expenses. We have construction costs that can spiral out of control, especially in India's volatile commodity markets. Then we have operating expenses from security to maintenance, which can compound over time. And then we have capital improvements, which are often underestimated by new investors. And then we go to the financial variables, which reflect market conditions beyond your control. So, for example, interest rate affects your borrowing cost. Exit cap rates determine your sale proceeds. Leverage ratios amplify both gain and losses. So, you can notice that how some variables you can control, others you don't. This distinction is fundamental in risk management. So then we move to setting test range based on the historical market data. So we have standard ranges. So we can have conservative, which will be plus minus 5%, which works for stable markets and established properties. Then comes the moderate variations, which can be of your plus minus 10%, suits most situations. Then we have stress test of maybe plus 15, minus 15, plus minus 15 to 20% variation, and that helps you understand the extreme scenarios. Then let's look at Indian market examples. So office rent, it can swing from plus 10 to plus minus 10 to 15% over market cycle. The best example would be the IT sector's volatility over the past decade. Then we have residential prices that shows plus minus 20 to 30% in volatility. Like maybe markets like volatile markets like Mumbai and Bangalore will be a good example. Then we have cap rates of typically 6.5 to 9.5% depending on the location and asset qualities, which we have seen that depending on how the type of property you are talking about, it can vary. And then we have construction cost, which can vary plus minus 8 to 12% annually due to material price fluctuations. So these are aren't just any arbitrary number. These are based on historical market data, and your range should reflect actual market behavior and not your wishful thinking. So if you are feeling very optimistic, your range should not change as per that. Or if you are feeling pessimistic, your then ranges will change according to that. So that is not how you should actually see. You actually should believe what the historic market data tells us and accordingly take the action. Then we go to the one variable rule. We also call it ceteris paribus. So this is where discipline separates professionals from amateurs. So basically the one variable rule means you change only one variable at a time while keeping your base case, while keeping everything else basically constant. So this is called your ceteris paribus analysis. Here the systematic process: first establish your base case with all variables at expected level, then change one variable by your test amounts and calculate the new IRR or NPV. Then reset that variable, then test the next one. Repeat this process systematically for all key variables. Now look at the example with a base IRR of 15%. A 10% rent increase pushes IRR to 18.5%, while 10% decreases drops it to 11.3%. That's a 7.2 percentage point swing. from just one variable. This basically telling you that rent assumptions deserve careful attention. Now, beauty of this approach is its clarity. You can see exactly how much each variable matters to your returns. So this guides where to focus your due diligence and ongoing management attention. So we have discussed this earlier that there are variables which are more important and need more focus. So this test can help us in determining that which one basically is affecting us the most. Then we go to the tornado charts. This is your visual guide to risk prioritization. So it's called a tornado chart because the widest bar at the top creates a tornado-like shape. So reading this chart is basically straightforward. Widest bars represent the highest impact variables. These are your primary risk. Narrow bar represent lower impact variables. The ranking goes from most to least sensitive. So for management focus, this chart tells you everything. Concentrate your effort on the wide bar variables. Monitor high impact factors closely. Consider hedging uncontrollable risk where possible. Don't waste time obsessing over variables that barely affect your returns. And notice how this visual immediately shows you where the real risk lies. Right? So in seconds, you can see which assumption, if wrong, will significantly impact your investment performance. So that is how it can be very useful, that it can help you understand the situation very quickly. Now let's take one example. We have a Pune office building case that represents a typical institution quality investment in India's IT hub. The base case setup shows a Class A office in Hinjewadi IT Park. This location choice is basically taken because of a reason, as it represents established demand with major IT companies. The building size is 250,000 square feet, which is substantial enough to attract large corporate tenants, but not so large so as to create leasing difficulties. Our 450 crore investment reflects current market pricing for premium office assets. The base IRR of 15% aligns with institutional return expectation. And then the 7-year hold period is typical for value add strategies. Now, key assumption deserves scrutiny here. So we have current rate of 85 rupees per square feet per month, which reflects premium positioning. The 4% annual rent growth assumption needs validation against historical IT sector expansion. Then 87% occupancy is healthy but leaves room for leasing risk. And then 8% exit cap rate assumes market condition remains stable. Now see the sensitive analysis. Now market range changes creating significant IRR impact, and this insight is crucial for investment success. So basically a 10% rent decline drops IRR by 11.3%. That's a 3.7% point impact. Conversely, a 10% rent increase pushes IRR to 18.5%, adding 3.5% point. The asymmetric impact reflects the mathematics of percentage change, right? So the key insight here is that revenue management is critical to performance. So this isn't surprising, but the magnitude might shock you. A relatively modest rent change creates substantial return impact. This tells you that market research, competitive positioning, and tenant retention deserve significant attention. For practical application, this means you should spend considerable time validating rent assumptions, understand the local market dynamics, tenant demand patterns, and competitive supply pipeline. And then basically your rent assumptions aren't just numbers, they are the foundation of your investment thesis. Then let's look at the exit cap rate sensitivity. So here you can see a 7% exit cap rate increases IRR to 18%, a 3 percentage point gain, right? A 9% exit cap rate drops IRR to 12.3%, a 2.7 percentage point loss. So what insight we can develop from this? Exit timing may matter most than operations. So you can optimize occupancy and control expenses, but if you sell into a weak market with high cap rates, your return suffers significantly. So this highlights the importance of market timing and exit strategy planning, right? So cap rate reflects market sentiment, interest rate environment, and asset quality perceptions. Unlike other operation metrics you control, cap rates depend on broader market conditions. This creates a different type of risk that requires different management approach. Then we go to the tornado chart. Now, the exit cap rate shows the widest range at 5.7 percentage point, making it our most sensitive variable. Market rent follows closely with a 7.2 percentage point range. And then we have operating expense registered with just a very small 1.2 percentage point impact. So the strategy priority is clear. We have market factor dominating controllable factor. So whether your exit cap or your market rent, that is the most important. So this finding is typical in real estate. You have more control over operations than market conditions, but market conditions often matter more to your returns. This analysis guides your risk management strategy. So you should hedge or monitor market factors closely, consider timing your exit carefully, and focus operational improvements on factors that actually matter. Don't waste excessive effort on expenses that barely impact the returns. Then we go to why scenarios basically beat sensitivity. Now we move beyond sensitivity analysis to scenario analysis, a more sophisticated approach that reflects real world complexity. The limitation of sensitivity analysis is that it tests one variable at a time, but market doesn't work that way. In reality, multiple variables change together in predictable patterns. So consider a real world example. During economic downturns, rent decline and vacancy increases simultaneously. When interest rate rise, borrowing cost and exit cap rates typically rises, right? So borrowing cost is increasing and exit cap is also typically rising. Then during IT sector growth, demand increases, rent rises and vacancy falls, all happening together. So scenario analysis provides a holistic market view with realistic narrative. Instead of isolated variable changes, your model complete market conditions. This enables strategic contingency planning. You can prepare for different market environment before they occur. Then we move to 4 standard scenarios. So professional real estate analysis user uses 4 standard scenarios that capture the range of possible market conditions, right? So understanding these scenarios is essential for comprehensive risk assessment. The base scenario represents most favorable condition, most likely outcome under your normal economic conditions. expected infrastructure delivery, and balanced supply-demand scenario. This should be your central case for planning purposes. The upside scenario models favors conditions, basically looks at favorable conditions. We have strong economic growth, we have infrastructure acceleration, and limited new supply. Then the third one is your downside scenario, representing challenging, but of course not the catastrophic. These are showing challenging conditions, not catastrophic conditions. Economic slowdown, we have infrastructure delays and oversupply concerns, and return decline but remain positive. Then we have the stress scenario, which is severe adverse conditions. We have economic crisis, we have major tenant failure, and we have regulatory upheaval. This scenario tests whether your investment can survive extreme conditions without total loss. So, one example would be that the big events such as COVID-19, which impacted commercial real estate all over the world. So, such type of scenarios can be your severe adverse scenarios. Now, each scenario tells a complete story about market conditions, not just isolated variables. So, basically, when this will happen and when this will happen, it will impact all the variables, not just one, and they will be impacted together. So, this narrative approach helps you understand cause and effect relationship and plan appropriate responses. Now, power of scenario analysis depends on variable consistency. All variables must align with your economic narrative. This is where many analysts fail. Look at the consistency table, right? In the upside scenario of 8% GDP growth rate drives 15% employment growth, enabling 8% rent growth and reducing the vacancy by 12%. Right? Every variable supports the same economy story. Stress scenario shows minus 1% GDP, minus 5% employment, minus 3% rent growth, and ballooning of vacancy to 35%. Again, all variables align with economic logic. Then we have inconsistent scenarios, destroying analytical credibility. You can't model strong GDP growth with declining rent or economic crisis with low vacancy rate. Economy relationship must make sense, so that we have to remember inconsistent scenarios we should avoid. This consistency requirement forces you to think deeply about market dynamics. How do macroeconomic conditions affect your local markets? What are the transmission mechanisms from national trends to property level performance? This thinking process is as valuable as numerical results. Then we go to Gurgaon residential scenario. Our 500 unit development is in sector 83. The 350 crore investment is there. Key assumptions: 7,000 square feet sale price, then 25 per unit per month absorption, construction cost of 3,500 per square feet, and timeline is 48 months. Base IRR is 22%. Now, let's see the scenario results. So, in the upside scenario, sale prices reaches 7,700, absorption accelerates to 35 unit per month, and time compresses to 36 months. The result is 34.5% IRR and 2.8 times equity multiple, exceptional return that justify the risk. The stress scenario tells a different story. Sale prices drop to 5,600, absorption slows to 10 units per month, and timeline extends to 72 months, result minus 4.7% IRR and 0.7 equity multiple, a significant equity loss. So 39 percentage point IRR range which we are getting, unlike stabilized income properties, developed projects can produce either exceptional return or substantial losses. So this analysis guides your investment decisions. Does the upside potential justify the downside risks? For many investors, the answer depends on their risk tolerance and portfolio diversification. So the answer has to be taken by the investor. Then we go to risk assessment. So this scenario analysis reveals critical insights for investment decision making. The range of outcomes help you understand what you are really buying. Key insights from your analysis: 39% IRR range, stress scenario, equity loss risk means you could lose your entire investment under adverse condition. Significant upside potential offers attractive return under favorable condition. The base case appears achievable under normal market conditions. Ultimate question becomes, does the upside justifies the downside risk? And there is no universal answer for it, and it depends on the risk tolerance, portfolio construction and investment objective, basically varying from one individual to another. Then we go to Monte Carlo simulation, probability distributions. Now we advance to this particular concept. The most sophisticated risk analysis technique, instead of testing discrete scenarios, Monte Carlo uses probability distribution to model uncertainty. So probability distribution reflects the reality that variables don't take single values, they have range of possible outcomes with different probabilities. So common distribution type includes triangular distribution for rental growth, minimum, most likely and maximum, normal for construction cost, mean plus minus standard deviation, and beta distribution for vacancy rates, bounded range with skew. The rental growth example illustrates the concept. Instead of assuming exactly 5% growth, we model a triangular distribution with 2% minimum recession, 5% most likely, and 8% maximum boom. So this captures the uncertainty inherent in real estate market. This approach is more realistic than sensitivity analysis or scenario analysis because it explicitly models uncertainty rather than testing discrete cases. The computer considers thousands of possible combinations weighed by their probability of occurrences. So we have 10,000 random iterations which are done by a computer, and this harnessing of computer power to explore outcomes is done systematically. Each iteration follows the same process. The computer randomly samples from each probability distribution, calculate IRR using the sample values, record the result and repeat. With 10,000 iterations, we can explore the complete range of possible outcomes. This process is impossible to do manually, but trivial for computers, and modern softwares like Excel, R or specialized real estate platforms can run these simulations in seconds. So the computational power transforms our analytical capability. Beauty of this approach is comprehensiveness. Instead of testing a few scenarios, you are testing thousands of combinations. Instead of asking what if rent drops 10%, you are asking what's the probability distribution of all possible return given all possible combination of input variable. This shift is from point estimates to probability distribution, which represents sophisticated investment analysis. Then here we have one case of Bengaluru office investment. The statistics from 10,000 iteration provides rich insights. Mean IRR of 15.7% represents the expected return, while the standard deviation of 4.2% measures return volatility. 80% confidence interval of 10.3% to 21.2% means that 80% of outcome will fall within this range. The probability analysis answers specific questions. There is a 47.5% chance of exceeding 16% IRR, slightly less than a coin flip. There is a 18.2% chance of return below 12%. Roughly 1 in 5 probability of disappointing results. So this information is actionable. You can decide whether a 47.5% chance of exceeding 16% return justifies an 18.2% chance of sub 12% returns. Different investor will reach different conclusion based on the risk preference. The analysis also revealed return volatility. A 4.2 standard deviation means return could easily vary by plus minus 8 to 10% point from the mean. This volatility level helps you understand the uncertainty or in your projections. So the moot question is, why risk matters? So understanding risk adjusted return is crucial because raw return can be misleading. High return don't always means better investment if they come with disproportionate risk. Problem with comparing raw return is clear in our example. Investment A offers 18% return with 3% volatility. Investment B offers 22% return with 8% volatility. Which is better? The answer isn't obvious without considering the risk. This is where the risk-adjusted metrics become essential. They help you compare investment with different risk profile on an apple-to-apple basis. So professional investors always use risk-adjusted return for investment comparisons. So we have Sharpe ratio, which is the most widely used risk-adjusted return metric. It measures return per unit of risk, helping you compare investment with different risk profiles. Formula is straightforward. Return minus risk-free divided by standard deviation. You subtract the risk-free rate because investors should only be rewarded for taking risk above the risk-free alternative. Look at our example comparison. We have Mumbai office generating 13.5% IRR with 3.2% standard deviation, producing Sharpe ratio of 2.03. Pune residential, which generates around 18% IRR with 5.8% standard deviation, producing Sharpe ratio of 1.9. And the third case producing Sharpe ratio of 1.87. And the winner, of course, here with the highest risk-adjusted return despite having the lowest absolute return. This is your Mumbai office. This counterintuitive result shows why risk-adjusted return matters. The Mumbai office provides the best return per unit of risk taken. So these examples were basically briefly touched upon in last class, but right now we are deeply going into them and understanding how the risk is basically included in the returns, and then we have a proper understanding of the return. It's not just return in isolation, it has to be in conjunction with what kind of risk or volatility we are talking about. Then we have Sortino ratio. So Sortino ratio refines the Sharpe ratio concept by focusing only on the downside risk. This approach recognizes that upside volatility isn't risky. Investors don't mind when return exceeds the expectation. Concept is intuitive. Upside volatility represents pleasant surprises that exceed your target return. Downside volatility represents the unpleasant surprises that fall short of the target. So the formula replaces standard deviation with downside deviation, return minus risk-free rate divided by downside deviation. This focuses the risk measurement on actual downside or outcomes rather than all volatility. Then we have break-even analysis. So we have briefly talked about break-even analysis. Example will better help us, understand this. So with 66.7% break-even occupancy and 85% current occupancy, there is 18.3 percentage point safety margin. This means that occupancy could fall substantially before debt service problem occurs. Right. So this analysis is crucial for leveraged investment when you use debt financing. So there is a minimum performance threshold below which you face financial distress. Understanding this threshold helps you assess the margin of safety in your investment. Then we go to portfolio diversification. So portfolio diversification, we can go for geographical allocation, we can go for property tax type mix. So basically idea is that we are trying to diversify and reduce the danger, whether we are going for geographical allocation, diversification, property type mix, we can do all this to lower correlation, reduce the overall risk. So if the two different properties are like for example, you have office and hospitality, they might have less correlation between them. Correlation means that their movement together is not exactly same. So if the movement of office and hospitality is not generally same in the same direction together, that is the basic understanding of correlation. So if it's not together in the same direction, if we create a portfolio, this will be beneficial. Why it will be beneficial? Because if they move together in the same direction at the same rate, then in that case our portfolio, we are adding the more and more units of different types, but because as they move or behave in the same fashion, there is no diversification. And the concept of diversification is that if there is some shock, we have units in our portfolio that behave differently. So overall we can have a positive impact or overall we can have a negative impact, but not together. They all are adding and creating the same thing. So that is the kind of concept we have for diversification, and that is why lower correlation has a value. Then we also have to understand the contractual risk allocation. So smart investors don't just analyze risk, they transfer risk to parties best equipped to manage it, right? So the agreements which we form, right, so they should be done in such a way that the risk goes to the right party which can bear it. So triple net lease, for example, transfers property tax, insurance and maintenance to the tenant. Escalation clause transfer inflation risk, right? And security deposits provides protection against tenant default. So the principle is risk allocation to the best manager. Fine. So these type of arrangements we can do to safeguards the parties, both the parties. Then we go to example of Mumbai mixed use project, the 1200 crore development project. Market risk from 4 competing projects threaten the absorption and pricing. Financial risk from interest rate sensitivity. Environmental risk from flood proximity. Mitigation strategy here would be demonstrate, will be phase development, office, residential, retail, which will reduce the market risk by allowing market response validation. Then we have interest rate caps, provide financial hedging against rate increases. And elevated system addresses environmental design challenges. So that can be the comprehensive system which we can adopt to curtail the effects of risk, or we can manage our risk. The outcome 19%, 19.3% IRR versus 22% target shows how risk management enables acceptable return even when original projection prove optimistic. So the 2.7% point shortfall represent the cost of risk management but ensures project survival and profitability. So we are not going for the best outcome, we are going for the best, safest. You can see after we have considered the risk management, this is the safest way to achieve our targets, right? Then we move to the second part of this class, which is about REITs. So here in this we will be discussing about the concept of REITs. REITs is a concept which has been there since 1960s. It started in USA. Earlier it spread in different parts of the developed world, but now gradually we can see that it is being adopted in more and more countries. And in India in 2014 the REIT Act was passed, and since then in 2019 we had our first REIT which got listed, and after that we have seen that there has been some progress which is there in this area of REIT. Now we have 5 REITs, out of which 4 are mainline REITs and one is your SME REIT. We will talk about that briefly, that what is the difference, but that is what has been the progress. So now we will discuss what this REIT is. We have understood the concept briefly in the starting few lectures. So basically REIT is that company that own, operate or finance income producing real estate. So they are basically holding these real estates. Mostly it is commercial real estate, and it acts just like a mutual fund. So mutual fund comprises of different shares. REIT is basically you can say a mutual fund in a very loose way, a mutual fund of real estate properties, mostly commercial properties. And the idea is that whatever rent they are earning, for example, in India we have office REITs. Primarily they own and operate office commercial properties. So whatever rent they are getting from their tenants, that is then distributed to the clients. So there is a big percentage of dividend distribution which is required. So that is how this whole process is basically. That is how the REIT functions. So it is an indirect way to invest in real estate, unlike the direct investment. So REIT structure, investors are there. Then we have REIT, they are putting their money in REIT. REIT is buying the real estate assets. Generally it is transferred from the sponsor companies which form the REIT to REIT structure, and these assets are then producing the rental income. The tenants are paying them the rental income, and which is returned back to the investor in the form of the dividends. Then global versus Indian REIT framework. So I have given briefly touched upon this area that REIT started in 1960, and there has been a lot of progress in this area, and in 2014 in India it started. One more requirement of REIT is that 90% of their net distributable cash flow has to be given to investors. So that is something which you can say helps investor earn good dividend income, and it is mandatory for the REITs in India to list themselves on stock exchanges. So it is kind of a hybrid you can say investment vehicle, which has both the real estate qualities and also the qualities of stocks which are there, which it is similarly listed on the stock exchange. And there have been certain developments, recent developments, that SEBI has, has basically, because there was a fractional, there was units, fractional ownership platforms were there, which were operating for properties where you can have direct co-ownership. So these type of platforms were working, and SEBI wanted them to be under some kind of regulation. So SM REIT was introduced in 2024, and that is basically the 50 to 500 crores REIT can also come up. Earlier it was only for mainline, which was 500 crore plus, and the 4 top REITs which we have in India are those type, and recently we had a SM REIT also. And also when REIT started, they started with a high denomination requirement, minimum high denomination requirement, but now anyone can invest in REIT by simply buying one share, just like any other equity investment. This type of investment can also be done in REIT, where you can buy a single share of REIT. So for example, if Brookfield is trading at 350 rupees, you can buy 1 unit of Brookfield at 350 rupees. So that kind of flexibility has been brought into this system. So that is how the progress has happened from 1960, first time the REIT coming in USA, and now in India we have a properly formed REIT market, and it is quickly gaining up. So that is the REIT structure, 3-tier structure in India. Listed entity, we have these REITs are holding these properties under special purpose vehicles. So different projects might be there under REIT. So there will be a project in Bangalore, there might be a project in Chennai, there might be a project in Mumbai, and there they have these projects under different SPVs, and all of these SPVs are under the REIT, and these projects are returning the rental profits, and these are then given back to the investors. And another criteria which makes REIT very safe is that their investment has to be in rent generating property. So at least 80% of that has to be completed and income generating, and maximum that has to be 80%. That is the main criteria. Then we have this we can see that minimum asset sizes, these are for your mainline REIT, that 500 crore asset size should be there. Then 80% in completed rent generating properties. Then we have 90% of net distributable cash flow requirement should be there. Then quarterly distribution is mandatory every quarter, like when the quarterly results are given, that time REITs are giving their dividends to their shareholders, their unit holders. And REITs governance is basically independent REIT manager has to be there. Then enhanced cyber security requirements are there. It has to be properly managed, and there are ESG reporting mandates which are applicable to other companies, but the REITs also follow them, and not just follow them, they follow the international criteria also, because a lot of the investors in REITs in India are from other parts of the world. Foreign investment is a lot there in the Indian REIT. So basically it's a much more stable and safe avenue for the investment. And current Indian, we have embassy office. I have listed these 3 established one. One newly REIT has come up, that is the Nexus Select, which is the first retail REIT in India. But apart from that, the other three mainline REITs are basically office REITs, and I have included them here because they have some amount of history and some information which we can talk about. So portfolio is significant in all of these. Market cap is also gradually picking up, and they are like, even though the number of REITs in India are less, but the size of these REITs are at the top of the Asian REITs. So they are one of the top most biggest REITs in Asia. And Mindspace Business REIT. So Embassy, you will see that mostly it is there in Bangalore, Mindspace in Maharashtra, and Brookfield, you will see that it's in the northern part. So that is how, you know, it has expanded. Then we have you know, digital access. All the REITs are accessible just like shares. You know, steady return we are getting. This is something which is just like any fixed income you know, vehicle. So this is something very good, that a good steady return of dividends is always there. Plus there is a price appreciation. Then there are tax advantages also. It's just like, you know, being treated as fixed income vehicles. And then because of the high regulation, it is very, very clean and safe, transparent system. Then we have seen that the market cap is significant, very high, around 95,000 crores. This can keep on fluctuate, but generally it is considered good because even though it was first started in 2014, the first listing happened in 2019, so there has been a good progress. The demand is also good for REIT products, and many foreigners are also now investing in this. Then we have good return coming up. Sometimes you know, the dividend is around 7%, 8%, and plus apart from that, there is some you know, price appreciation also. Then the comparison. So direct REIT, you have to, direct real estate, specifically in commercial real estate, you have to have a significant investment. Liquidity is very low. REIT, just like share, is very high. Returns are good in direct real estate investment, but REIT investment is stable. The technology integration is also not there in the direct real estate. REIT, it is very easy to buy and sell it. And then we see that direct real estate might not be you know, ESG compliant, is generally self-managed, while REIT are, you know, generally they are LEED certified buildings under these SPVs of theirs. And then financing is basically, there is a leverage control in REIT as per the SEBI regulations. So the, you know, this part is also there, that leverage is also less. And maintenance of this is not, as REIT management will be responsible for the maintenance of properties. Direct, you will have to manage it on your own. And then you can access generally direct real estate in your own market, but not in the overall anywhere other parts of the world. REIT is basically pan-India, depending on which REIT you are looking at. Currently, you can see that it is being picking up. There is less knowledge about this investment vehicle, but now HNIs, institutions, and, you know, even the new investors which are of the younger generation, they are also now investing in such indirect investment tools. Future outlook is very good. You can see that it is emerging, and because of, you know, the kind of size of REITs, we can expect that this will keep on continuously growing, and more REITs will be formed. And the risk mitigation is also one of the very good criteria here, that we can use this and include it in our portfolio and reduce our risk. So the key takeaways. So mastering this risk analysis, we should be aware of sensitivity analysis, scenario analysis. That one we started with fixing one particular variable, moving on to moving multiple variables together, then creating simulation of 10,000 iterations, and then also looking at risk adjusted return. So this kind of analysis we can do. And also we understood that REIT is a good alternative, indirect investment alternative. So we get an overview of that. Also specifically we focused on REITs which are available in India. So thank you so much for this particular class.